Hey everyone, and welcome to the HASHR8 podcast. I am the Bitcoin Broski, and I have got a special guest today. And we are going to get into a subject matter that I am looking forward to discussing, widely contested in the mining community. It's stock to flow. And our guest on the show today is Jesse Proudman, CEO of Strix Leviathan. Jesse, welcome to the show, man. How are you?
Great. Thanks for having me.
Hey, it's a pleasure. And thanks for sending over that research piece on stock to flow. I read it yesterday, and it's great. You guys did a very good job. I'm excited to dig into it today.
Thank you. Nico and our team has done a phenomenal job researching this one.
Excellent. Well, so Jesse, tell me a little bit about yourself and how you got started in Bitcoin.
Absolutely. So I'm a longtime entrepreneur, had a company in 2003 called Blue Box, what ultimately became a cloud computing company. Sold that company to IBM in June of 2015. Spent about 2.5 years at IBM as a distinguished engineer, first year and a half integrating the product. And then the second year I was working with IBM Ventures to launch a blockchain focused accelerator. So this was over 2017, which was a great time to be researching the space. Certainly a space I've been familiar with for a long time. I actually went to college with both Nick Carey from blockchain.com and Eric Voorhees from Shapeshift. We were all in the same business class at University of Puget Sound. So I've watched over the shoulders of those two guys as they've built their businesses with curiosity. But the summer of 2017 was really the first time I had sort of the intellectual capacity through work to be able to spend time diving in and figuring out what's happening here, and really became hooked sort of the moment I started.
Yeah, it's easy to fall down the rabbit hole, right?
Yeah.
So what led to Strix Leviathan? How did you go from IBM, previous entrepreneurial experiences, to starting Strix Leviathan?
Yeah, so the program I was working at IBM, we were going to launch a blockchain focused accelerator. So my job effectively was to become a subject matter expert on the space. And so over the summer of 17, basically became a sponge. I was reading everything I could, listening to podcasts, books, blogs, Twitter, Telegram, sort of any and everything. And from that, started kind of looking at some of the price action that was happening in the space, and became pretty curious on a couple characteristics that felt intriguing to me. This was an asset class that certainly had sort of material volumes flowing through it, where volatility was pretty crazy, and where data was publicly available. So if I want to trade stocks, to get access to sort of historical market data or individual trades that have occurred in the stock market, that's data you have to go pay for. And in this market, every exchange sort of publicly presents all of that data available to anybody who wants to subscribe to it. And so it felt like this was a really interesting opportunity to be able to sort of collect that data, normalize it, store it, and look for patterns. And began to form a thesis around applicability of algorithmic trading after staring at these charts for long enough. Sort of like everybody does this at the beginning. They're like, okay, staring at these charts, and there's visual patterns I can see in these things. And if there's visual patterns I can see in these things, they have to be programmatically, or I should be able to programmatically define them. And so felt like there was an opportunity to build at least a prototype set of software to go do that. And by the end of Q4, IBM had come back and said there wasn't a budget to go launch the accelerator. And I knew I wanted to do something in this space, was so fascinated what was happening here. And this opportunity around the algorithmic trading side really felt like an opportunity to go scratch an itch that incorporated both sort of my technology background, because you can't, like, there aren't software platforms out there to really go do this effectively, and to go explore sort of a new domain on the financial services side. So it was basically 3 days after Bitcoin's all-time high. I remember looking at the timestamp on my text message. I sent Sadie, my co-founder, a message and said, hey, I have this idea. Do you want to go try to start this business? And she signed on right away. So I left IBM on the December 31st and started Strix in January of 18.
So we're not too far apart there. My first entrance into crypto was December 29th of 2017.
Okay.
So
yeah,
looking back through an old trading journal then. Yeah, it was kind of the same thing, right? Like I looked at these charts. I'm not a quant. I'm not a mathematician. I'm not a trader by school, or it's just I took an interest. I was looking at the charts. You see these patterns, and then you assume that you can predict where the price is going to go. And here I am 2 years later, so 3 years later. So it's been a great ride. Now, Strix Leviathan, you have done a phenomenal job of growing that. And I mean, starting it when you started it, what was it like as a new business owner in crypto, coming in at the top basically, and then dealing with the subsequent 2 years of 2018 and 2019?
Yeah, I think we both couldn't have started at a better time and a worse time to some extent.
Yep.
So Strix Leviathan is
Sure.
a quantitative hedge fund. So we have a pooled investment vehicle where qualified purchasers invest capital, and then we manage that for them. That fund itself started in the middle of April of 18. Strix Leviathan itself, the parent company, has developed and operates a software platform that hedge fund uses to trade capital. We originally raised venture dollars, venture capital, to fund the development of that platform. And I started that raise process in January of 18. So on one hand, like, we were sort of right in the midst of the frenzy of everything crypto. And so it was significantly easier to raise the equity capital than I think I'd anticipated. And people are just excited about the space, and we're excited about sort of tools and technologies that could try to go capture alpha from the space. And more importantly, I think crypto is a space that is challenged from the characters that are involved. Like, you have a lot of anonymous people, you have a lot of fraud, you have a lot of like, it's just a bizarre space. And so sort of new entrants that come from the entrepreneurial world who have sort of a track record and a background, that was really interesting to a lot of the investors that we spoke with. So we're really fortunate in being able to raise the capital to go build the software we needed to trade this space. But then effectively May of 18 was our first month of trading, and May of 18 to the end of 18 was a straight line down. And so as a fund, the first set of strategies we launched were long only strategies. So we made money when the markets went up, and when the markets don't go up for 7 months, becomes a very challenging proposition. So we've learned a lot. I mean, I think at the end of the day, the timing worked out in our favor, and sort of the longevity and the ability to withstand that kind of market condition from a track record perspective has been really attractive to folks. But it certainly was a challenging time for us.
I bet. Well, what do they say? The entrepreneurs that started in the hard markets are the ones that, have the mettle to make it through in any time periods. So it's good that you were able to. Hey, I mean, I think all entrepreneurs have to be crazy in some little way, shape, or form, right? What did Elon Musk say? It's like chewing on glass and staring into the abyss.
Every day.
I think that pretty much sums it up. But it's still like, my wife thinks I'm nuts, and I tell my friends, being an entrepreneur is like having a disease, right? Like, it's very hard to communicate what you're feeling inside, why you're excited about this rare thing, and every day you're just fighting for survival. But it's exciting. But I want to get into stock to flow. Obviously, we're here to talk about that. You have done a phenomenal job, your team has, with the research piece. You mentioned some anon Twitter characters, and it just so happens that stock to flow has been perpetuated, promoted, talked about by a gentleman on Twitter, Plan B, who is a Dutch investor. And let's get into it. So what was it that led you to research stock to flow in the first place?
So the crypto space is one where price action seems to be driven primarily by narratives. And a year ago, we got really interested because the narrative at the time was the halving is coming and the halving pumps price. And a lot of that was focused on this stock to flow model. And so we spent time last year researching the halving of Bitcoin, as well as the halvings of a number of other coins with similar sort of emission schedules to Bitcoin. And the conclusion that we came to was effectively that there is no correlation between halving and price action sort of in the months preceding or the months following a halving. Sort of saw that somewhat to play out accurately with the Litecoin halving. But it was a powerful piece for us because it really highlighted the fact that these popular narratives, they get passed around when you actually look at data behind them, often turn out to be totally false. We see this a lot with things like CME gaps, like people saying, oh, it's going to fill the gap. Like all kinds of these narratives exist. Right. So after that research, we decided to start to look at stock to flow because that has become such a widely shared model. I mean, you see it everywhere. You see it in money managers managing hundreds of millions of dollars. They'll put it in their monthly update and say, here's why we believe Bitcoin's going to go up, because the stock to flow model says it will. And it, for us, particularly as an investment manager who approaches this space from a data perspective and quantitatively, that drives us nuts. Like, so we started to say, okay, let's actually look at this model from two perspectives. Let's look at it both from sort of the quantitative perspective, and then let's also look at it just at the theoretical perspective. And it became very evident just at the very beginning of this project that the model itself is something that we like to call a chameleon model.
Well, and, you know, backing it up there, when you're talking about family funds, including this in their monthly reports, it's hopium, right? It's just feeding into. So why would a money manager who, I mean, should have the wherewithal to be able to see that this is not accurate, why would they include this in a report that goes out to their clients or to prospective clients?
I mean, it's a compelling model at first review, right? I mean, I think to say, look, there's a statistically significant model that indicates that the price of Bitcoin is going to go up dramatically. And here's why you should invest in our fund. And look, it's been fairly accurate in the past. Like, that's a compelling argument to some extent, and particularly if you don't scratch the surface. And so a lot of it, in our eyes, it's a marketing document. It's how do you get new money to come enter the crypto space? Because at the end of the day, the price action goes up here when new money enters, and the price action goes down when that money leaves. Like, it's pretty simple in that capacity. So the entire cryptocurrency asset class needs sort of these marketing pieces to some extent to attract new money. And this is one that has felt at least compelling. Like it looks like it is rooted in science or in research.
Well, I mean, I guess Bitcoin has been the best performing asset of the last decade. However, I mean, to me, it just seems a bit unethical. I mean, and I don't know that there can be such measurements of ethics, whether it's a bit or a lot. I think it's just unethical is unethical. And it just strikes me as that, right? When you're using marketing is fine, but statistical models like this that are shooting for 100K Bitcoin inside of this year.
Yeah, I mean, the model at one point says Bitcoin is going to be $235 billion per coin. Like when you map it out. But yeah, I mean, it's a great question. Like, what sort of responsibility do those promoting these narratives have to the broader industry to really fact check the underlying models themselves? Like, I think there's plenty of reasons to participate in this space. We think it's fascinating from a technology perspective. We think there's economic reward to participate in this space. We're not believers in our fund that buy and hold is a responsible or appropriate way to approach managing assets here, which is why we've set our fund vehicle up that way. But this space is interesting. Like, that's why we're here. But it's important to approach this space with eyes wide open, right? It's an experiment. We're 10 years into an experiment with hundreds of billions of dollars on the line. And nobody really knows what the next decade, the next 2 decades, 3 decades are going to hold. And so trying to model out that using pretty simple linear regressions, it's just not appropriate. But at the end of the day, people need something to talk about. And research is hard. And there's a lot of reasons why kind of approaching it this way and feels interesting to people.
Well, I mean, some of the largest players in the space are the ones that are perpetuating this model. And it begs the question, do they know and they still just use it? Or do you think that they really are missing the boat on the model itself? Have they bought into the hype themselves and are just not intelligent enough to understand that it's inaccurate?
I don't know if it's an intelligence thing. I think there's two issues here. One, to understand what the model is saying is not a simple process. Like I'm not the quant on our team. I'm not the statistics guy on our team. Like at face value, stock to flow seems really interesting, and the story feels compelling. Like you read Plan B's narrative and you're like, oh, I get this. Like Bitcoin's going to $100,000.
$235 billion
right,
Bitcoin.
I'm going to be super rich. But it took our team quite some time to sort of dig into all the nuance of what's going on here, to run our own analysis on the data, to pull our own data. So it takes effort. And there are other people that have done sort of similar levels of analysis. But then the challenge is, how do you take this analysis, which is fundamentally complicated and technical, and doesn't necessarily make sense to people who don't have statistics degrees, and how do you communicate it in a way that debunks this story? And so that's what we've tried to do with this piece, is try to communicate the deficiencies that exist here in a way that everyday people can understand.
And I think you've achieved that. I'm not a quant, nor am I a mathematician, nor am I a professional trader, and it made perfect sense to me. And I guess, you talk a little bit about biases in the piece itself, and I clearly come into it with my mind kind of already made up about stock to flow, just based on some of the very basic principles of it. However, dig a bit, because you talked about the chameleon model a little bit before. Can you dig into why is stock to flow a chameleon model, and what is a chameleon model for anyone that doesn't understand?
Yeah, it's a great question. So there's a Stanford professor, I'm going to probably butcher his last name, but Paul Fluffender, who coined the term a chameleon model to describe a model.
Good.
We'll see. To coin a model that are built upon dubious assumptions and give them more credence than they deserve. So he's got this quote: to take a decidedly extreme example, imagine an asset pricing model based on the assumption that there is no uncertainty about an asset's returns. No serious person would suggest that the predictions of the model should be subjected to rigorous empirical testing before rejecting it. The model can be rejected simply on the basis that a critical assumption is contradicted by what we know already to be true. So when we design models for trading, like the very first thing we do is define like the thesis for the model, right? We don't just run a machine learning algorithm and it spits out some mathematical formula and we say, aha, that's the right trading formula, we're going to use that going forward. No, we start with a thesis. Like, what are we looking for in the data? What do we believe to be true that this model will identify? And so it's pretty important to start when we do kind of any analysis, you start there. Like, what are we trying to say about the model? Or what is the model trying to say about the world? And does that make sense? And the challenge with chameleon models is that they seem and they appear at review to be accurate. Like the mathematical modeling can be true, but if the assumptions that underpin them aren't accurate, then the model itself is irrelevant. There's that great set of analogies around like divorce rates and butter in the state of Maine, and it charts out like margarine versus butter purchases and divorce rates, and the data points map with incredibly high statistical accuracy. And so you could make the claim that like the transition from margarine to butter has resulted in more divorces based on this statistical analysis. And everybody would know that that's absurd.
Right.
But you start to wrap up that same analysis in financial terminology, and you apply it to Bitcoin, and everybody heralds it as the world's best price prediction model. So that's the challenge. I think the first big, like, people have to understand what stock to flow is, and a lot of the terminology that Plan B uses is a little different from what people would expect. But basically, in his original paper, Modeling Bitcoin Value with Scarcity, the thesis is that certain precious metals, things like gold and silver, maintain monetary value because they have effectively a low rate of supply. And so you could think about that like there is a significant amount of gold already in existence, and the rate of new supply that comes online as a percentage of that aggregate supply already in the market is very small. So if you double the production of gold, and I think it's like 1.5% is cited in the document today to 3%, like that new supply doesn't necessarily impact the aggregate supply in a meaningful way. And so that benefits that benefits gold where other commodities are used. And so the supply that's sort of on hands today is smaller to what is being produced. And so you could flood the market much more easily, which is kind of interesting when you think about something like diamonds, right? Like the supply of diamonds, the flow is just artificially held back.
Correct. Yes.
But so that's his notion that gold is valuable because effectively the current supply divided by new supply is, which is his equation for stock to flow is high. And so then he tries to translate that to say Bitcoin's characteristics are similar, that Bitcoin is and has always been digital gold, and that because of the emission schedule with sort of new coin coming online, being halved approximately every 4 years, that gives you a sort of a high stock to flow number over time, and that stock to flow number is effectively or entirely what drives the US dollar market cap value of Bitcoin. And through his analysis, he pulls a bunch of stock to flow data and builds a linear regression, which from 7th grade math, if you remember, it's sort of the y equals mx plus b model. So he builds this linear
slope
regression.
Intercept. Yeah.
Yep. And then kind of graphs that all out on a graph that looks pretty with a bunch of colors, and concludes that that because Bitcoin has a similar stock to flow characteristic of gold, and Bitcoin is digital gold, and that there is a R squared of approximately 0.95, that this is a statistically significant model that can be used to forecast the price of Bitcoin. And I think a lot of folks are using it to claim that Bitcoin's going to $100,000 this year. So that's the model, right? Like, would you agree with that summary?
I would agree with that summary. And I think that it speaks to like economics 101. Like when you're first year of university, you take econ 101, supply and demand. And I think that's where this thing takes off, because most people can grasp that as, supply and demand interact to impact price, right? And I think that's why it's gained the traction that it has, because that's a very easy thing to discuss. And then when you bring in the halving, which is a complex topic that is, I think, across the board, those two factors together, I can see why people can use this as a marketing tool. Because for the average person who just has, money to invest and they want to see a return, I mean, it makes sense.
Absolutely. So like over the last 6 months, as we've begun to talk about stock to flow on Twitter, anytime sort of you say something controversial, you'll get this huge stream of anonymous Twitter personalities who will say it's supply and demand, dummy. Like, don't you get this? It's so basic. And it's endless. Like it's an endless list of replies that all say the same thing. Look, supply goes down and demand stays constant or goes up. And even now you're getting that. People will say like, look, Grayscale is buying up all the new coin emitted. Like that should be an indicator that the price is about to go through the moon. So yeah, this notion of supply and demand, I think is really key. And because that's a pretty easy concept for everybody to grok, that becomes kind of this rallying call that people try to apply to this model. But this model doesn't really have necessarily much to do with supply with demand, right? It's a model that is looking solely at what's the count of coin that is already available and what's the new count of coin that is being emitted on a month-to-month basis. And how do we use those two numbers to predict what the true price of Bitcoin should be?
And there's just so many factors that come into play when it's just about how many coins are going to be emitted on a monthly basis. I mean, if you look back since the halving and the delay in block times and how, as they space out, that's less coins that are created on a timed basis. The stock to flow doesn't factor that in. You have all kinds of factors with hardware that come into play that can determine how fast blocks can be can be won and how fast the coins can be emitted. That's not factored in.
Things like
I
ASIC
think that's
boost.
why a lot of the mining. Yeah, and I mean, a lot of the mining community has always had a problem with stock to flow, right? Like I'll joke with Steve Barber of Upstream Data about this because, like, for a while there, every Saturday he would just take some time out of his day, crack a couple of beers, and throw some shade at Plan B on Twitter, joking about stock to flow. But it's just the narrative has gotten so large that it's like you said, anyone who speaks out against it, you've got the Twitter brigade that's coming to say that you're fudding or you're trying to, drive down price or whatever. When I think a lot of us just look at it like stock to flow is the opposite, right? Stock to flow is like the ultimate supply of hopium and just this unrealistic price projection. I mean, we're under 10K right now, which would mean that to go to 100K this year, we're going to 10X from here, the price of Bitcoin. Well, I mean, great, let's do it. But I mean, realistically, it's hard to say that that's going to occur when there's really not a factor on the horizon that would say that that's going to happen.
The other big thing here that's really curious to me, sort of unrelated to stock to flow, is just this notion that sort of every coin that is emitted as part of the Coinbase reward is sold, right? I think people don't really most people, and including myself, I won't claim to be a mining expert, but most people don't understand the economic realities of industrial scale mining that we have occurring right now, right? In the last two Bitcoin halvings, like the very first Bitcoin halving, mining was really a hobbyist activity. And sure, there was money behind it, and sure, like people were serious about it, but it was not the sort of tens to hundreds of millions of dollars per data center that people are investing
right.
To build out these facilities that we have now. We also didn't have sort of the level of sophistication in derivatives products in the previous two halvings.
Exactly.
So sort of the options markets, the futures markets, and the depth of and the depths that exist there now, as well as the lending markets. Like all of that is new to this halving, and all of that gives miners different options with how they approach the economic realities of running their businesses that change, in my mind, everything. And then lastly, it's sort of
Absolutely.
like coming from this from a quantitative perspective. Like if I had a model, like a trading model that made two trades and they were both incredibly good trades, like I would never put that live, because a sample set of two, like you have no idea. But people are using this sample set of two prior halvings to say, well, that's exactly what's going to happen in the third halving. And so there's not enough data there at all, in my eyes, to make any kind of legitimate claim. Oh.
Well, and the point that you make about the financialization around Bitcoin mining, I think is one that will start to come to bear more and more as people realize that, like, you look back at how many coins have been sold since the halving. And the reason that it's down is because miners don't have to capitulate now. If they're operating below profit, they can take their Bitcoin reserves and they can borrow against that and stay afloat for as long as it takes until the price gets to where they're profitable again. And that's playing, I think, the biggest role in why we're seeing, the amount of coins mined versus the amount of coins sold, and how that's all playing out. Now, the other aspect on the flip side of it, when it comes to the hopium, right? Everyone involved in this community assumes that the price of Bitcoin is going to go up, right? Like otherwise, why would you dedicate your life to this? Why would you start a business? Why would you trade? Why would you provide an ancillary, product or service? I mean, you think the number's going to go up. So when someone says the number's going to go up, like a little piece of you wants to just agree. And, you mentioned, I forget the gentleman's name who wrote the article about it, but the magic of numbers, right? Like that illusion that can be cast when you start to put numbers on paper and someone already has a bias and they're looking at these numbers, the numbers themselves almost don't matter. And
right.
People aren't going to look too much into it if it's just confirming what you would like for it to say. So, God, yeah, it's so where do we go from here though? Like your guys'
Well, so can we highlight on some of the problems real quick? Because I think
I would love that. Let's jump into the problem.
Yeah. So if we understand stock to flow, you have to believe that gold is sort of the representative model for what Bitcoin stock to flow is going to do. But the challenge there is that you have to believe that gold's US dollar market cap is entirely derived from its stock to flow value, because that's effectively what he's saying about Bitcoin. And when you start to look at gold itself, you quickly realize, and in our research, we chart this out, that the market cap compared to stock to flow basically is an $8 trillion range.
Right.
$8 trillion, right? Like, it's not a nice, cute graph like the Bitcoin stock to flow model looks like. It's a scatter plot with really no correlation.
Sure.
And so much of that in reality is driven by the inflationary characteristics of the US dollar, right? People buy gold because they want a hedge against US dollar inflation.
Correct.
And the thesis is that sort of the purchasing power of gold stays constant while the purchasing power of US dollar declines. And so sort of right off the bat, using gold as an analogy for what Bitcoin will do, like, it immediately holds no weight. So the very first sort of thesis is invalid. Like, so right off the bat, we shouldn't even be talking about this anymore. So there's problem number one. Problem number two is around the fact that he's effectively saying Bitcoin is digital gold, and it has this emission schedule that makes it functional like that. And that because gold has this particular value, Bitcoin will mimic it. But there are dozens of other cryptocurrencies that have the exact same emission schedule as Bitcoin. And I'm not saying that these are the same things, right? There are absolutely reasons why Bitcoin is more valuable than things like Litecoin or any of these other coins. But there's no analysis for stock to flow on those coins. One of the things, right, again, going back to sort of quantitative analysis that we do, if we find a model and it works really well on Bitcoin, the very next thing we do is we go and we test it on every other coin we have in our data set. Because just matching something against one particular asset just tells you, particularly one particular asset with so few data points in its history, just tells you that you've built a fit model to those data points. It doesn't tell you anything about how it's going to perform in the future against other sort of market conditions. So the fact that sort of we're only looking at Bitcoin and not any of the other coins, and doing any sort of analysis or review there is really interesting. So that's kind of problem number two. The third problem really is around this use of the linear regression, believing that it's sort of a predictive equation versus a equation designed to estimate values. And I won't really go into the nuances of the math because this section sort of gets fairly complicated. And I've had to reread it like 7 or 8 times to really understand it well. But at the end of the day, the important thing to realize here is that this model effectively says that the price of Bitcoin is going to infinity. There is sort of no upward cap of what the price of Bitcoin is, because the way Bitcoin's flow, the emissions work is that they slowly converge to zero. Mm-hmm. And as they slowly converge to zero, this model just infinitely increases its market cap prediction. And we've got a good visualization of that, kind of mapping sort of the existing Plan B stock to flow visualization that makes sense. Like, I kind of see that. That makes sense. That predicts kind of the market cap is going to $100,000. But then when you chart it out over the next 20, 30 years, all the way up to 2045, I mean, it's literally absurd. At one point, Bitcoin's $235 billion per coin. And so you can make an argument that at some point you just need to draw sort of a cap and say this model no longer exists. But at what point do you call that? Like it's not necessarily logical to say it at $1,000 billion, the market cap, like that's where the model no longer works.
So how do you get to a point of invalidation then? Like if the facts don't matter, right? Like you've clearly done research, and I'm sure others have as well, and the model still exists, right? So if all of that doesn't sway people, at what point will this stock to flow model be invalidated just by price action itself? Is there a price that Bitcoin could go to right now on this chart that would invalidate the whole thing?
Yeah, that's a good question. I'm sure there is. I don't know what that price is off the top of my head. Certainly $1,000 would likely do it.
Okay.
And I think it's interesting to kind of watch Plan B tweet, because they'll sort of say, oh, as price moved around, particularly the March 12th drop that we had, there's always some line about, oh, that fits within the model. So I've never seen him
be
present
wrong.
any concern that price does not fit within the model. And again, narratives are really powerful here, right? It's not to say that price doesn't do this.
Right.
It's entirely possible that Bitcoin could go to $100,000 this year. It's entirely possible. It's just not going to be a function of stock to flow. It's going to be a function of new money entering the space.
Right.
And that new money help pushing the price up. So, that's the challenge when you do analysis like this, because if the price continues to sort of map against the model, people are going to say, well, you are wrong. Like, no, we're not necessarily wrong. The model is just not a predictive model. And it's great if the price sort of continues to follow along this curve. Like, I think everybody involved in the space would be delighted if Bitcoin was at 25,000, 50,000, 100,000. Like, it would continue to validate sort of all of the work that we're all doing,
right,
in our retrospective businesses. But using this as justification for why we're getting there is crazy.
Well, so then it just begs the question, will anyone care, right? Will anyone care to stop using this? If its numbers along a plotted line, and even if Bitcoin doesn't go to 100K this year, if there's another flash crash down to 3,500, right? Will ethics step in and cause people to stop using this model, or will they continue to put these in their reports and try to use it to generate investment dollars for their funds?
Yeah, I think one of the big challenges that we've had in the space, and I kind of talked about it at the beginning, it's a space full of odd characters, and a lot of the rules that traditional fund managers operate by are ignored here. I remember in 2018 reading sort of other fund presentations, and their competitive differentiation was that they traded on inside information that was in the marketing deck. That's how they differentiated the fund. That's insane. It's insane. Like, fine, people trade on that kind of stuff all the time, but it's insane that you're putting that, and we trade everything quantitatively. I'll make that very clear. But to market that, no. And so, we spoke to another traditional fund manager last week who was laughing that people in this space even do podcasts, that fund managers in this space do podcasts, because that's such a foreign concept in the traditional asset management world. So at some point, we as a community need to recognize that each and every one of us represent this space, and sort of the way we behave, the way we communicate on Twitter, the content we produce, the research that we produce, all of that is representative of the cryptocurrency space. And if we expect institutional money to enter this space, if we want family offices and pension funds to allocate capital to the space, we need to think about how we're marketing it. And because the analysts at each one of these entities are just as smart as our team, and can do the same level of research as our team, and can look at this model and say, this is a joke. And they will. And that's this drumbeat of institutional capital will save crypto that has been banged on since sort of the middle of 2018. Like, we continue to hear that over and over and over, and that institutional capital is not here. And I think a lot of that has to do with the type of research that is promoted within this space. And we're starting to see that change, right? Fidelity did a phenomenal report recently. There've been a lot more high quality research pieces coming out from sort of big brands and well-respected entities that highlight why this space is interesting and important from a portfolio perspective. But we all need to hold ourselves accountable to think about, what are we saying, and how factual and accurate is it? Self-policing
is required. It's if we don't step in and start to do these kinds of things, for one, mass adoption is never going to occur. But also there's going to be a swift hammer coming down from people, because retail will always pay somewhat attention because there's the potential of gaining wealth in cryptocurrency. But without self-policing, it's just going to lead to a bunch of blemishes on the industry as a whole, just like we saw with the ICO hype. And probably you could argue we're getting ready to see with this DeFi hype that's going on right now. Yeah. So, and that's a whole nother topic in and of itself. I'm just glad they've stopped calling it yield mining. It's not mining. I think that's sacrilegious almost. But, Jesse, I'm really grateful that you were able to make the time to join me for the conversation today. And when will the piece be released? When are you guys going to put that out officially?
Yeah, we're expecting it to come up this following week.
Excellent. So everyone keep an eye out for that. We will have a link in the show's notes to the article itself, so you can read all that Jesse's team has put together on Stock to Flow. But Jesse, thanks for coming on.
Yeah, and I want to say a big shout out to Nico on our team, who spent a significant amount of time doing all the research for this, and to Matt, who's done a great job kind of helping put it all together. So certainly a big team effort from everybody at Strix. And thank you for having me on.
That's awesome.
This was great.
Hey, it was a pleasure. I'd love to do it again sometime. And to the listeners of the HASH8 podcast and the viewers, I've got to remember to say both now because we are on YouTube and Twitch. I appreciate you guys for tuning into the show. Remember to smash the like button, subscribe to the channel, leave us a comment, rating, and review on your preferred listening platform. And stay tuned. We have a lot of new material coming out over the following weeks. But for now, we'll talk to you guys all again very soon. Take care. Thanks for tuning into the HASH8 podcast. I hope you enjoyed this episode. If you did, please consider liking and sharing this episode with a friend. Also, remember to subscribe to our channel for more amazing content. And if you haven't already, I'd suggest you subscribe to HASH8's weekly email difficulty adjustment. It's a newsletter focused on the most important stories in Bitcoin, cryptocurrency, and mining, delivered right to your inbox each and every Wednesday morning. You don't want to miss that. Be sure to head down to the show's notes and subscribe to difficulty adjustment newsletter today. And remember, each week HASH8 does a special giveaway for one subscriber to the newsletter. So by subscribing to difficulty adjustment newsletter, you are registered for each week's giveaway. And for those of you who don't yet follow us on Twitter, I'd encourage you to do that. We are at HASH8. That's at H4SHR8. Thanks again, and we'll see you next episode.